Okay, learning objective 5, we kind of take a step back to step 7 now. So we finished looking at the full accounting cycle. We looked at closing entries, posting those, and our post-closing trial balance. Now we're going to dig a little bit deeper and take another look at the classified balance sheet. So in chapter 1, when we discussed the financial statements, I did go through a classified balance sheet example. So we did the craft brewery example, and we broke out our current assets and our current liabilities from those long-term assets and liabilities. We didn't have any notes on it, so we'll look at it again now and add some notes. So this hopefully is a little bit of a review. Okay, so when we talk about classifying assets and liabilities, we're looking at breaking these out into current and long-term, but we also classify them in terms of their relative liquidity. So liquidity is defined as how quickly an item can be converted to cash. How quickly an item can be converted to cash. So we typically talk about liquidity of assets. So cash is already cash, so it is the most liquid. You could use it immediately to pay something off. Accounts receivable is often the next most liquid because we just need to collect that. So we've already either done the work, if it's accounts receivable, we've done the work for the customer, either provided the service or the good. Now the only step left is to actually collect that accounts receivable. Inventory would be less liquid than these two items because inventory is something we sell to customers to make revenue. So if we have this inventory, now we need to sell it and then collect it if it's sold on account. So that means it's going to take longer than what's already sitting in AR because we still need to sell it, then collect it. So when you look at a balance sheet or a trial balance, these items, assets, they're listed in order of their liquidity. And why do we do this? Well, users of financial statements, they're interested in the liquidity of the business. So they're looking at, does this company have enough cash or current assets they can quickly convert to cash in order to pay off their liabilities when those liabilities become due. So we want to break out these current assets and liabilities so the user can quickly look at that and see if the company is going to be able to pay off their debts. So as I said, on the balance sheet and in completing or preparing trial balance, accounts are listed in their order of liquidity or their intended use. So cash is already cash. It would become first. But the benefits of a company owning a delivery truck, they might have those benefits for 10 years. So this has a lower liquidity, or it's less liquid, and we would show this in the long-term section. And we talk about intended disposition or liquidity. So again, liquidity is how quickly it can be converted to cash. But some of our assets we never convert to cash. We never sell them. And like a truck is an example of that. Or supplies. We're using up those items. So as we use them up, they're then disposed or consumed. So that's another way, because you may never convert those to cash. Okay, so we would list these in order of liquidity, but specifically, we break them out into current and long-term items. And then we have subtotals of each of those. And as we'll see in a minute, an asset or a liability could have both a current or a long-term, and a long-term portion. So a bank loan, for example, if you make monthly payments on the loan, the amount that you would pay in this current period, so the next 12 months, that would be your current portion of the bank loan. But anything that remains to be paid in future years, that's the long-term portion. So we'll see that when we look at an example. Okay, so our first breakout that we will see on a classified balance sheet are current assets. And current, as we talked about back in chapter 1, are assets that are expected to be converted to cash, sold, or consumed during the next 12 months. So current equals 1 year or 12 months. So assets that are expected to be converted to cash, sold, or consumed during the next 12 months. Or the next year. We can see there's 3 different ways to use up or have an asset be current. So the first is that you convert it to cash in a year. If we look at the examples here, cash, accounts receivable, notes receivable due within a year, supplies, prepaid expenses, and inventory. Cash is already cash, but which of these would be converted to cash within a year? Well, that would be these first 2. So these will be converted to cash. When we collect our accounts receivable or our note receivable, we're converting it into cash and we're receiving that cash. The second part here in the definition is that it could be assets sold during the next 12 months. And in our list below, that is inventory. Inventory is something that we sell to customers. That's what the purpose is. We're selling it to make money. So we sell that within a year, so it's a current asset. And then the last part is that you could consume it during the next 12 months. And that would be supplies and prepaid. So supplies, we use those up. We buy them, they sit on the shelf, but then we're going to use them up over the next year. So we're consuming those goods. Prepaid expenses, we've paid them, and then in the next year, we're going to consume or receive that benefit. So these are consumed within a year. So 3 different parts to what makes something a current asset. Okay, so next we look at long-term assets. Well, long-term assets are just anything that are not current. So these will be either converted to cash, consumed, or potentially sold with or beyond 1 year. So it takes more than 12 months. Examples of these are property, plant, and equipment. So our land, our buildings, furniture, vehicles, things like that, as well as goodwill and intangibles, and long-term investments. These would go under long-term assets because the benefit of each of these is beyond 1 year, beyond 12 months. So we classify our assets. We also classify our liabilities as current or long-term. Current always means 12 months. So current liabilities are debts that are due to be paid or settled within 1 year. So debts due to be paid or settled within 1 year or 12 months. It's equal to a year. Examples of current liabilities: accounts payable, notes payable that are due within a year, salaries payable, taxes payable, interest payable, unearned revenue, and then the current portion of a bank loan. So most of our liabilities are something that we're eventually going to pay in cash. So all of these payables and the current portion of the bank loan payable, so this one as well, those are all going to be paid in cash. So if you bought something on account, eventually you're going to pay that supplier with cash. If you have employees, you're going to pay them cash. Unearned revenue is the odd one out that we have here. So let's take a reminder of what unearned revenue is. This is when we are paid cash in advance from a customer, but we haven't done any of the work or the service to earn it yet. So we haven't provided the goods if we're selling those. We haven't done the service. So we haven't earned this yet. For unearned revenue, you will settle this by either doing work or settle it by providing a good or a service. So we're not paying cash for this. Instead, the debt that we owe is to provide this good or service. But for all of these, this will be done within 12 months. Long-term liabilities are liabilities that aren't current, so not current. So they will be paid or settled beyond 1 year or beyond 12 months. Examples of these are long-term notes payable. So these are amounts due after 1 year, and a bank loan that is due after 1 year. Okay, so now we know about current assets, long-term assets, current liabilities, long-term liabilities. Let's see how these look on a classified balance sheet. So when it says classified, that means we've classified current and long-term amounts. So they're broken out into those categories. There's two types of classified balance sheets. The first one that you can do is what's called an account format, and that's what you see here. So this is broken out where you have your assets on the left side and your liabilities and equity are shown on the right side. So remember, the balance sheet is looking at our accounting equation, and we know that our assets must equal liabilities plus equity. So the account format looks like the accounting equation. So you can remember it that way. It actually looks like it because it's broken out left and right. We have our current assets broken out. We get to the total current assets. The long-term are shown below to eventually get to total assets. On the right side, current liabilities are broken out and we get to the total. And then this company just has no long-term liabilities. So that's why nothing's shown here. If they had any long-term amounts, they would be listed here, but they don't have any. Then we show the equity and eventually get down to our total liabilities and equity. We know these must agree, and they do. So we get that check mark. So the accounting format is where you break it out left and right. Assets come on the left side, liabilities on the right side, liabilities and equity. The other type of classified balance sheet, so the second type, is called the report format. Now, this is a different company, so clearly different accounts here. But if we have the same account here it would just show your liabilities and equity section below the assets. So that's how it's laid out here. Your assets come on the top portion, and then below it, you show liabilities and equity. So it just stacks assets on top of liabilities and equity. That's the only difference. You break out the accounts in the same way. It's just two different ways of showing that same information. Okay, so let's take a look now at just in a little bit more detail. So this is a blown up example of the classified balance sheet for CAM company. So we know with any type of financial statement, we name it with the company name, what statement it is, and then the date. So the balance sheet is always at a date. So this one's at June 30th, 2019. And you can see here, as I noted, you break the current assets out first and get to total current assets. Anything below that is the long-term amount. So you don't necessarily have that heading long-term assets and then break them out. But if it comes after the current amount, it is long-term. And then we get down to total at the end. So a couple of things that I want to pick out here. And the first one is discussing this note receivable. So we see in the current assets section, the current portion of the note receivable. And then down here in the long-term section, we can see this broken out. So this is one type of current asset, or one type of asset, or an example that shows that an item can have a current portion and a long-term portion. So this note receivable that we loan some money to someone, the repayment schedule clearly says that a portion needs to be paid out within the next 12 months, but then there still remains a balance that gets paid out beyond that. So if that's the case, you need to break out this current portion. So the $51,600 will be collected by CAM company in the next 12 months. Therefore, it meets our definition of current. But the remainder, this $48,400 that we see down here, this will be collected after 12 months. So there's only one note receivable, and the total balance right now is $100,000. But we're going to collect a portion in this next year, and then the remainder will be collected in future years. So the users want to know this information, so we break it out this way on the balance sheet. Okay, I think that's what I wanted to point out here. Then we can see just below we've got the different types of long-term assets. So all of our property, plant, and equipment with this contra account for each of them. So we're breaking out that accumulated amortization, which we know brings down the dollar or the value of the item. So $60,000 less this $18,000 accumulated gets us to our $42,000. And this shows why we needed to break out or have a specific account for accumulated amortization for equipment, and why we had one for furniture. Because then we can pull the balance for each of these assets and show it separately on the balance sheet to get to the net amount for each of these. Okay, so that looks at the asset side. Now this shows just a continuation for CAM company, but the liabilities and equity portion. So same idea here that I want to point out about the current portion of note payable and how this note payable is shown here. So we borrowed money from somebody and we have this note. The total balance that we still need to pay is $220,000. Within the next 12 months, we need to make payments of $72,200. So that needs to be paid by the end of June 2020. But there's still another $147,800 that will be paid after 12 months. So we break this out. We show the current portion under current liabilities, and we show the remainder under the long term. So this current portion will be paid within 12 months. The rest gets paid after that. And for long-term debt like this, you will often see this because loans typically have a monthly payment that's required. So every month the company pays down a certain amount, and therefore we record the 12 monthly payments as current, and the rest sits in your long-term amount. Okay, so that looks at an example. Now let's quickly break this out into where these items would be reported on the balance sheet. So we're going to prepare a classified balance sheet, and you've been given a list of these 8 accounts. So we need to know how to classify them. Will they fall under PP&E, current assets, current liabilities, or a long-term liability? So pause the video, try this on your own. Pick out whether each of these fall under A, B, C, or D, and then when you've gone through them all, you can play again and we'll go through it. Okay, so prepaid rent is a B. It's a current asset because we're not going to pay rent for more than a year. That just wouldn't be a good use of our cash. Typically, you pay rent maybe at the start of every month, or it needs to be paid in the previous month for the next one, but it's possible maybe you pay for a year or 3 months or 6 months, but it is a current asset. Unearned revenue is C, a current liability. So you owe some customer either to provide them with some sort of services or provide them goods that they've paid you for. And they're not going to pay you more than a year in advance. So this would fall under current liabilities. Okay, so a note payable that is due June 30th, 2022. And we said that right now we're at the balance sheet date of December 31st, 2019. So June 30th, 2022 is more than a year in the future. So therefore, this is D, a long-term liability. We don't have to pay it for 2.5 years, so it's long-term. Accounts receivable is B, a current asset. We're going to collect that within a year. Accounts payable is a current liability, so C, because again, we're going to pay that within 12 months or a year. Accumulated amortization for the truck. So where would this fall? Well, it links, or it's the contra account that goes along with the truck, and it is part of PP&E. So that falls under Part A. It is that contra asset, so it sits on the balance sheet with the truck. Supplies is B, a current asset. Again, a company is not going to purchase so much supplies that it sits on the shelf for more than 1 year. They would only buy enough to use in this short-term period, so within a year. So it is a current asset. And the company truck, well, we're going to have this truck, we expect at this point, for more than a year. So trucks or any other type of property, plant, and equipment are lumped together as PP&E, which is a long-term asset. Good. Now that we've gone through that, here was the craft brewery example that we looked at in Chapter 1. So since this is kind of a review, I'll just let you take a look at this. If you want to try it again, you can. And I'll post the video where we went through this solution. As well, in our live class in Chapter 1, we talked about the terrible toys example. So you could look back at that as a review as well.